Right now, as I write this analysis, silver is hovering somewhere in the $70 to $75 range. And just 2 days ago, silver was sitting at $60. A month before that, it was trading in the mid-80s. Fortunes were made and destroyed in a matter of hours. And the story behind why this happened is fascinating. What you're about to hear is a detailed factual breakdown of what actually drove silver off a cliff, why the so-called recovery you are seeing today is far more fragile than anyone on television is willing to admit, and what the next 5 days could mean for your money, your portfolio, and the broader American economy. Stay until the very end, because every minute of this detailed analysis is full of financial knowledge we must know in these times of global market panic. Today is Wednesday, March 25th, and the silver market is doing something that looks on the surface like healing. To anyone glancing at a chart casually, this might appear to be a market that stumbled, caught itself, and is now brushing off the dust. But that interpretation could not be further from the truth of what is actually unfolding beneath the surface. Just 2 trading sessions ago, on Monday, March 23rd, silver plummeted to $60 per ounce, a price level that would have seemed absolutely impossible to even the most pessimistic analysts as recently as late February of this year. That crash did not happen in isolation. It was the culmination of a 9-session losing streak that carved roughly 30% off silver's value in what felt like a slow-motion train wreck accelerating into a full-speed derailment. To put that in perspective, a 30% decline in fewer than 2 weeks is the kind of drawdown that typically accompanies systemic financial crisis, not routine market corrections. The last time silver experienced a comparable percentage drop in such a compressed time frame was during the March 2020 pandemic liquidation, when virtually every asset class was sold simultaneously to raise cash. What makes the March 2026 crash distinct from those prior episodes is the specific cocktail of forces that converged to produce it. Forces that have not dissipated simply because the price bounced $14 off the low. The trigger, as most of you following the news already know, was a dramatic escalation in geopolitical tensions centered on the Middle East, specifically involving the United States, Iran, and Israel, and a rapidly deteriorating security situation. The immediate market consequence of that escalation was a massive spike in crude oil prices, which in turn sent the United States dollar sharply higher as capital fled to the perceived safety of dollar-denominated assets. Now, most people hear the words geopolitical crisis and precious metals in the same sentence and instinctively assume that gold and silver should benefit because the old textbook says hard assets are safe havens during times of conflict. That assumption has been proven dangerously wrong in this particular episode. And understanding why it failed is arguably the most important financial lesson an American investor can take away from the past 2 weeks. The mechanism is straightforward once you see it clearly, and it runs directly through the oil market in the Federal Reserve's reaction function to inflationary pressures. When crude oil spiked violently on the back of the Middle East escalation, it did not create a gentle, manageable increase in consumer prices. It created an acute inflationary shock that forced the Federal Reserve into a corner. The Fed, under its current leadership, has been laser-focused on core inflation readings, and a sustained surge in energy costs feeds directly into transportation costs, manufacturing costs, food production costs, and virtually every other input in the American economy. Higher oil does not just mean more expensive gasoline at the pump. It means higher prices for everything that moves on a truck, a train, a ship, or an airplane, which is essentially everything Americans buy. When the market began to digest the implications of sustained triple-digit oil prices, it did not rush into silver as a hedge against that inflation. Instead, it began pricing in the likelihood that the Federal Reserve would have to maintain or even increase its already restrictive interest rate policy. This is the crucial mechanism that most retail investors miss entirely because it runs counter to the simplified narrative they have been taught about precious metals and inflation. In a normal inflationary environment where central banks are accommodative and real interest rates are negative, silver and gold absolutely function as inflation hedges and tend to rise alongside consumer prices. But in an environment where the central bank is actively fighting inflation with high nominal interest rates that produce positive real yields, the opportunity cost of holding a zero-yield asset like silver becomes punishing. Silver pays no dividend, it generates no interest, and it costs money to store physically, which means that when Treasury yields are elevated, the rational financial calculation shifts against holding metal and toward holding government bonds. That is exactly what happened during the 9-session losing streak. As the market repriced the entire forward curve of Federal Reserve policy expectations in response to the oil-driven inflationary impulse, every single day that oil stayed elevated, the probability of near-term rate cuts decreased, and with each decrease in rate cut probability, another layer of speculative silver longs was forced to capitulate. The word forced is doing important work in that sentence because what happened was not an orderly voluntary repositioning by thoughtful portfolio managers carefully adjusting their allocations. It was a cascading series of margin calls, stop-loss triggers, and algorithmic liquidation programs that fed on each other in a self-reinforcing downward spiral that is characteristic of leverage markets under stress. The Commodity Futures Trading Commission data, which lags by a few days, but will eventually confirm this, will almost certainly show a historic reduction in net long speculative positioning in silver futures during this period. The traders who were caught in that liquidation were not the long-term physical holders, the central banks accumulating reserves, or the industrial consumers locking in forward supply. They were the momentum chasers, the systematic trend following funds, the generalist hedge funds that had allocated a small slice of their portfolio to the silver bull thesis during 2025, and the retail traders using leveraged contracts on platforms that allow 50 to 1 or even 100 to 1 margin. This category of market participant, sometimes referred to somewhat dismissively as tourist money, had been the marginal buyer that pushed silver from the $50 range up into the mid-80s over the course of the previous year. Their buying was real, and it moved prices higher, but their commitment to the trade was shallow, conditional on continued upward momentum, and a low volatility environment that made carrying the position comfortable. When volatility exploded and the macro backdrop shifted from rate cuts to rate holds, that comfort evaporated overnight, and the tourists did not negotiate their exit. They stampeded for the door. The crash from the mid-80s to $60 was, in mechanical terms, the market finding out how much of the 2025 bull run was built on genuine structural demand versus leverage speculative positioning. The answer, painfully revealed in real time, was that a significant portion of the rally's upper range was speculative froth layered on top of a legitimate but lower equilibrium price. Now, fast forward to today, and the market has bounced to around $74, and the financial media is presenting this recovery as evidence that the worst is behind us, and that buyers are stepping in with conviction. The catalyst for this bounce, according to every major financial news outlet covering the story, is the announcement of what has been described as productive diplomatic conversations between the United States and Iran. The U.S. president, who had issued a 48-hour ultimatum that was widely expected to lead to direct military strikes, instead announced a 5-day extension framed as a window for continued diplomatic engagement. The market interpreted this announcement as a de-escalation signal, and the immediate effect was a sharp drop in crude oil prices, which fell approximately 11% from their recent peak on the news. As oil fell, the entire chain of logic that had been crushing silver reversed direction, at least on the surface, as lower oil implied less inflationary pressure, which implied a less hawkish Fed, which implied lower yields, which implied a weaker dollar, which implied higher precious metals. Silver responded accordingly, surging from the $60 crash low and reclaiming the $70 handle before pushing into the 70 to 75 zone where it sits as of this recording. The gold to silver ratio, which had blown out dramatically during the crash as silver underperformed gold on the way down, compressed somewhat during the recovery, but remains elevated by historical standards, suggesting that the market still views silver as the riskier of the two metals. For the American trader watching this unfold, the temptation to interpret the bounce as a buying signal is almost irresistible because the price action looks like a textbook V-shaped recovery off a capitulation low. But the critical question that separates profitable trading from expensive lessons is whether the buyers driving this recovery are fundamentally different from the sellers who just got flushed out. If the new buyers are long-term strategic accumulators, sovereign wealth funds, central banks, and industrial hedgers, then the recovery has a solid foundation and the $60 low may indeed prove to be the bottom. If, however, the new buyers are simply a fresh rotation of speculative capital betting on the binary outcome of the Friday diplomatic deadline, then the market is building a new tower on the same unstable ground that collapsed 2 days ago. The evidence available as of today points more strongly toward the latter interpretation, which is an uncomfortable conclusion, but one that the data supports. The speed of the recovery itself is a clue because genuine accumulation by strategic buyers tends to be slow, methodical, and often invisible in the price action, conducted through dark pools and over-the-counter transactions designed to avoid moving the market. What we saw on Tuesday and into Wednesday was a sharp, aggressive, high-volume snapback that has the fingerprints of short covering and momentum chasing, not patient accumulation. The options market provides additional context as the implied volatility surface for silver options remains extremely elevated, indicating that the market's own pricing mechanism does not believe the current calm is likely to persist. When implied volatility stays high even as the spot price recovers, it is the market's way of saying that large moves in either direction are still expected, which is inconsistent with a narrative of genuine stabilization. The term structure of silver futures is also telling a nuanced story as the front month contracts are trading at levels that reflect the spot recovery. but the deferred months have not rallied with the same enthusiasm. This backwardation dynamic, where near-term prices are elevated relative to future delivery months, can indicate physical tightness. But it can also reflect a market that is skeptical about the sustainability of current price levels. The bond market, which is often a more reliable narrator than equities or commodities, has also not fully embraced the de-escalation thesis. Treasury yields pulled back modestly on the oil decline, but the 10-year yield remains at levels that are restrictive. The Federal Reserve itself has been conspicuously silent during this period of extreme market volatility, which is itself a signal that they are not inclined to ride to the market's rescue with dovish rhetoric or emergency policy adjustments. Their silence communicates that they view the current situation as manageable within their existing framework, which means that the high-rate environment that has been a headwind for silver is likely to persist regardless of what happens with oil in the short term. For the American investor who holds physical silver, whether in coins, bars, or allocated storage accounts, the crash to $60 and the recovery to $74 has been a gut-wrenching but ultimately educational experience. Physical holders were not forced to sell at the low because they were not on margin. They did not face margin calls, and their metal did not evaporate when the price dropped, which is the fundamental advantage of unlevered physical ownership. The paper traders, by contrast, many of whom were long silver through futures, contracts, options, or leveraged exchange-traded products, discovered in the most painful way possible that leverage is a tool that amplifies losses just as efficiently as it amplifies gains. The stories emerging from trading forums and social media over the past 48 hours describe accounts that were wiped out entirely, years of accumulated gains erased in a matter of hours as cascading margin calls liquidated positions at the worst possible prices. This is not a new phenomenon. It happens in every major market dislocation. But it is a lesson that each new generation of traders seems determined to learn firsthand, rather than from the cautionary tales of their predecessors. Today, the Fed is holding rates at restrictive levels and has shown no inclination to cut, which means that even if silver does eventually recover to its prior highs, the path there is likely to be longer, more volatile, and more dependent on a genuine shift in monetary policy than many bulls want to acknowledge. The dollar index pulled back from the psychologically significant 100 level during this relief rally, and that pullback has been cited as a tailwind for silver's recovery. However, that dollar weakness is entirely a function of the oil price decline and the associated reduction in safe haven demand. It is a reactive move driven by a single variable, not a structural shift in the dollar's fundamental strength. The United States dollar remains backed by the highest short-term interest rates among major developed economies, a relatively resilient domestic economy despite the oil shock, and the deepest, most liquid capital markets in the world. These structural supports for the dollar do not disappear because a diplomatic headline temporarily reduced the perceived risk premium in energy markets. If anything, the dollar's pullback from 100 to its current level may prove to be nothing more than a pause that refreshes before the next leg higher, particularly if the Friday deadline passes without a concrete resolution. The maritime insurance market, which operates far from the headlines but serves as one of the most honest indicators of real-world risk, has not repriced its war risk premiums for vessels transiting the Strait of Hormuz. Insurance underwriters do not reduce premiums based on social media posts or press conferences. They reduce premiums based on verified sustained changes in the threat environment, and no such change has occurred. The Strait of Hormuz remains effectively a contested waterway, where commercial vessels require military escort to transit safely. More than 40 energy facilities across the broader Middle Eastern region have sustained confirmed damage, and the timeline for restoring those facilities to full operational capacity is measured in months and years, not days and weeks. This physical reality, the damaged infrastructure, the disrupted shipping lanes, the elevated insurance costs, and the reduced throughput capacity is the foundation upon which the oil price is ultimately set. No amount of diplomatic optimism can repair a damaged refinery or reopen a shipping lane that is within range of sophisticated drone and missile systems that remain fully operational and under the control of actors whose objectives have not changed. The American consumer is already feeling the effects of this energy disruption at the gas pump, at the grocery store, and in their monthly utility bills. And those effects will not reverse overnight, even in the best-case diplomatic scenario. Gasoline prices in the United States have risen significantly from their levels of just 2 months ago, and the national average is approaching levels that historically begin to affect consumer spending behavior and overall economic confidence. Consumer confidence surveys, which are leading indicators for retail spending and broader economic activity, had already shown deterioration before the most recent escalation, and the latest readings are likely to reflect further weakness. The current recovery in silver's price to $74 is not being driven by a surge in industrial buying. It is being driven almost entirely by financial flows responding to a macro headline. That distinction between financial demand and physical demand is one of the most important concepts for any American investor to understand, because financial demand is fickle, fast-moving, and capable of reversing direction in a single trading session. Physical demand, by contrast, is slow, sticky, and driven by real-world consumption needs that change gradually over quarters and years, not hours and days. The foundation of any durable silver rally must ultimately rest on physical demand exceeding physical supply in a sustained and structural manner. And while that case can be made on a multi-year basis, the short-term picture is far muddier. The 5-day diplomatic window that the president announced, which began on Monday and is set to expire this coming Friday, March 28th, is now the single most important variable driving silver's near-term price action. Every trader, every fund manager, and every algorithmic system in the precious metals complex is currently calibrating its positioning based on the probability-weighted outcomes of what happens when that window closes. The market, as reflected in current pricing, is assigning a meaningfully high probability to a positive outcome, some form of continued diplomatic engagement that prevents an immediate return to military escalation. This optimistic pricing is visible not just in silver, but across the entire commodity complex. As oil has pulled back sharply, base metals have stabilized, and equity markets have mounted a relief rally on reduced tail risk fears. But the history of Middle Eastern diplomacy, particularly when it involves the specific combination of actors currently at the table, suggests that optimism should be tempered with a heavy dose of skepticism grounded in observable patterns. The pattern that has repeated itself across multiple administrations and multiple decades is one of escalation, followed by a theatrical pause, framed as a breakthrough, followed by either a quiet return to the status quo or a renewed escalation that catches a complacent market off guard. The 48-hour ultimatum that preceded the current 5-day window is itself an example of this pattern. Because the ultimatum was not followed by the military action it implied, but rather by an extension that was presented as diplomatic progress. The question that the market is not adequately asking is what specific concrete verifiable conditions would need to be met within these 5 days to produce a genuine and lasting de-escalation. A framework agreement on nuclear enrichment limits, a cessation of proxy operations in multiple theaters, a mutual drawdown of forward-deployed military assets, and a mechanism for verifying compliance would all be minimum requirements for a deal that actually changes the strategic landscape. None of those elements can be negotiated, agreed upon, documented, and verified in 5 days, which means that even in the best-case scenario, the Friday deadline is far more likely to produce another extension or a vaguely worded joint statement than a binding resolution. Iran's official position as of today adds another layer of complexity that the market seems determined to ignore because Iran has publicly and repeatedly denied that any direct talks with the United States are taking place. This denial is not a negotiating tactic designed to extract better terms. It is a reflection of internal political dynamics within Iran, where direct engagement with the United States is viewed by significant factions as a betrayal of core ideological principles. The gap between what Washington is saying about productive conversations and what Tehran is saying about no conversations existing is not a minor discrepancy. It is a chasm that suggests either one party is misrepresenting reality or both parties are describing fundamentally different processes. For the market to be correct in its current pricing, you would have to believe that this gap will be bridged in a matter of days, and historical precedent offers very little support for that belief. Israel's military posture adds yet another variable that operates independently of the United States-Iran diplomatic channel, because Israeli operations in the region are being conducted according to their own strategic timeline and objectives. Israeli officials have been explicit that their current military operations are designed to achieve specific security outcomes that they view as existential, and those objectives do not pause or adjust based on American diplomatic timelines. The coordination between American diplomacy and Israeli military operations has historically been imperfect at best and openly contradictory at worst, and there is no indication that the current situation is any different. For the silver trader, this web of interconnected but independently moving geopolitical variables creates a risk profile that is nearly impossible to hedge effectively through conventional means. The traditional approach of buying put options to protect long positions is expensive in the current elevated volatility environment, with option premiums reflecting the same uncertainty that makes the hedge necessary in the first place. The cost of portfolio insurance, whether through options, inverse exchange traded funds, or other hedging instruments, has increased dramatically over the past 2 weeks, eating into potential returns and making risk management itself a significant drag on performance. Some sophisticated traders are expressing their view through option structures known as strangles or straddles, which profit from large moves in either direction regardless of whether silver goes up or down. This type of positioning is a bet on continued volatility rather than a directional view, And its prevalence in the current market tells you that even professional traders are uncertain about which way the next big move will go. A mining company that was profitable with silver at $80 and oil at $75 per barrel may find its margins squeezed dramatically if silver drops to $74 while oil remains above $100. This margin compression is not reflected in the headline price of silver or even in the stock prices of the miners during a relief rally. But it is absolutely reflected in the quarterly earnings reports and cash flow statements that will be published in the coming months. If oil stays elevated for a prolonged period while silver remains below its recent highs, the mining sector will underperform the metal itself, and the leveraged gains that investors expect from owning miners instead of physical metal will not materialize. The futures-based silver exchange traded products experienced much larger outflows and significantly worse tracking error during the volatile period, highlighting the structural disadvantages of products that rely on rolling futures contracts rather than holding physical metal. Understanding the difference between owning shares in a physically backed trust and owning shares in a futures-based fund is not an academic exercise. It has real financial consequences during exactly the kind of market conditions we just experienced. The physical silver market itself, meaning the market for actual metal bars and coins that are delivered and stored, has shown a fascinating divergence from the paper futures market during this crisis. Premiums for physical silver, which represent the markup that dealers charge above the spot price for actual metal in hand, have reportedly increased during the crash rather than decreased. This is the opposite of what you would expect if the crash were driven by genuine oversupply of physical metal, because in a true surplus environment, dealers would be competing to move inventory and premiums would compress. The fact that physical premiums increased while the futures price crashed suggests that the selling pressure was concentrated in the paper market where leveraged positions were being liquidated while the physical market remained relatively tight. For the American buyer of physical silver, whether for investment purposes or as a long-term store of value, the crash to $60 on the paper market may not have translated into an equivalent buying opportunity in the physical market because dealers adjusted their premiums to reflect the actual supply and demand conditions for real metal. The American economy entered 2026 in a condition that many economists described as late cycle, meaning that the expansion that began after the pandemic recession was mature and showing signs of deceleration even before the oil shock hit. Employment growth had been slowing, consumer credit delinquencies had been rising, and the housing market had been struggling under the weight of elevated mortgage rates for over 2 years. The oil shock has accelerated these pre-existing trends, adding an exogenous inflationary impulse to an economy that was already grappling with sticky core inflation and weakening growth momentum. This combination of slowing growth and persistent inflation is the textbook definition of stagflation, a condition that central banks find extraordinarily difficult to navigate because the tools for fighting inflation, higher interest rates, make the growth problem worse. The Federal Reserve's response to the current stagflationary impulse has been to prioritize inflation fighting over growth support, maintaining restrictive rates even as economic indicators weaken. If the situation improves and oil falls, the Fed may eventually feel comfortable discussing rate cuts. But the process would unfold over quarters, not days, and the market's current pricing of near-term relief is almost certainly premature. If the situation deteriorates and oil rises further, the Fed will be forced into an even more hawkish posture, potentially raising rates in the face of weakening growth, which would be devastating for silver and most other risk assets. This asymmetry in the Fed's reaction function is the single most important structural factor that the silver market is currently underpricing, because it means that the risk-reward profile for being long silver at $74 is not as favorable as the relief rally makes it appear. The dollar's role as the world's reserve currency and the primary invoicing currency for global commodity trade adds another dimension to this analysis. When global uncertainty increases, demand for dollars increases, regardless of what is happening with American interest rates, because international actors need dollars to settle trades, service debts, and maintain reserves. This structural demand for dollars during periods of crisis creates a natural headwind for commodities priced in dollars, including silver, because a stronger dollar makes those commodities more expensive for non-American buyers. The recent pullback in the dollar index from the 100 level has temporarily alleviated this headwind, but the structural factors supporting dollar strength, interest rate differentials, safe haven flows, and reserve currency demand remain firmly in place. Central bank gold buying, which has been a powerful structural tailwind for the gold market over the past several years, does not have an equivalent in the silver market. Central banks around the world have been accumulating gold reserves at a historically elevated pace as part of a broad-based effort to diversify away from dollar-denominated assets. This buying provides a floor under gold prices that simply does not exist for silver. Silver does not have a natural institutional buyer of last resort in the way that gold does, which means that when speculative demand evaporates, as it did during the crash to $60, there is no institutional backstop to catch the falling knife. The technological landscape for silver demand, while genuinely supportive on a multi-year horizon, does not provide meaningful price support during acute financial dislocations because industrial consumers adjust their purchasing timing and volume based on economic conditions. The 2026 fiscal policy environment in the United States adds yet another variable to this complex equation. As government spending decisions and tax policy directly influence economic growth, inflation expectations, and the Federal Reserve's policy calculus, the current administration's fiscal stance has been characterized by significant spending commitments alongside tariff policies that add their own inflationary impulse to the economy. Tariffs function as a tax on imported goods that raises prices for American consumers and businesses. And the tariff regime that has been implemented and expanded over the past year has been an independent contributor to the inflationary pressures that are keeping the Fed hawkish. The interaction between tariff-induced inflation and oil shock-induced inflation creates a compounding effect that makes the Fed's job harder and extends the timeline for any potential pivot toward accommodation. For silver, this means that the macro headwinds are not just geopolitical, they are structural and policy-driven, and they will not resolve themselves simply because the Strait of Hormuz reopens or oil prices moderate. The net assessment standing here on March 25, 2026, with silver at approximately $74 is that the market has priced in a significant amount of optimism about the near-term resolution of a crisis that shows no signs of being near resolution. The relief rally, while technically justified after the extreme oversold conditions at the $60 low, has carried prices to a level where the risk-reward is no longer asymmetrically favorable for new long positions. The $75 level represents meaningful technical resistance that the market has struggled with, and a failure to break convincingly above that level in the coming sessions would be a bearish signal that the recovery is losing momentum. The Friday deadline looms as a binary event risk that the market is currently positioned for a favorable outcome on, and any disappointment relative to expectations could trigger a rapid repricing that takes silver back toward the lower end of its recent range. The prudent approach for the American trader is not to chase this rally, but to respect the uncertainty that the market itself is pricing through elevated options, volatility, and cautious term structure signals. The $60 low may or may not prove to be the ultimate bottom for this move, but the path from $74 to a sustained new high above the mid-80s requires a fundamental resolution of the energy crisis, a shift in Federal Reserve policy expectations, and a weakening of the dollar, none of which are currently in evidence. The market is telling a story of hope right now, and hope is a wonderful human quality, but a terrible trading strategy. Because hope does not repair damaged oil infrastructure, reopen contested shipping lanes, or change the policy stance of the world's most powerful central bank. The underlying structure of this market, the unresolved geopolitical risks, the elevated energy costs, the hawkish Fed, the strong dollar, and the absence of institutional backstop buying, tells a story of fragility masquerading as recovery. The trader who recognizes the difference between a technical bounce and a fundamental shift in market conditions will be far better positioned to navigate whatever comes next than the trader who simply looks at a chart, sees a V-shaped recovery, and assumes the worst is over. What happens between now and Friday will determine whether the silver market's current chapter ends with a sigh of relief or a gasp of renewed panic.